And has Melissa joined yet?
Not yet.
Okay.
Is Melissa in host mode, do you think?
Welcome, everyone. We're just waiting on a few more people and we'll get started.
I see Melissa in the attendees, so she's here.
Yeah, my hope is that she can monitor the chat for questions. That's
Yeah.
one of the things that.
Or maybe he can, whatever works best.
Andres, you've now been tasked with a new duty.
Yeah, it's fine. Let's go for it.
I think last time we had Melissa as a host, and that's how we had her moderating. Yep.
Mm-hmm. It is awfully quiet.
Yeah,
Okay,
Melissa.
everyone.
Yeah,
Let's get
Melissa
started.
just sent a chat.
Good afternoon, everyone. This is Andres, Program Assistant for NAMMBA. So happy to be here today. I would like to first thank both Shelly and Kendall for being here, and also I would like to welcome every single one of you for joining us and welcome you to today's session on Loan Quality Initiative. Also, a special thanks to our sponsors and partners at Factual Data for their support and for hosting this webinar. Well, first of all, I would like to say, please keep in mind of our annual national conference coming up in September from the 16th through the 19th in Atlanta, Georgia at the Westin Buckhead. So if you're interested, please visit our events page on NAMMBA.org to register and for more details about our conference. And without further ado, today's speakers, welcome again. We have Kendall Lanier, Senior Account Executive at Factual Data. And we also have Shelly Werner, who is also a Senior Account Executive at Factual Data. So thanks again to you both for being here today as we look forward to hearing more from your expertise. So I'll go ahead and give the floor over to you, Kendall, so you can take it away.
Great. Thanks so much, Andres. I do appreciate that. One thing that I can appreciate about the NAMMBA convention or Connect 2021, I just spent some time at the Texas Mortgage Bankers Convention here in Texas. And, you know, long story short, one of my coworker valeted his car at the hotel. Someone took the tent from the back of his truck. So needless to say, I spent 5 hours on a golf course in the hot sun. And so, you know, I make it home. The first thing my wife says to me is like, "You were not at a conference where you were out on the beach fishing or something." And so it was great. And so I look forward to Connect 2021 on September 16th. The great news is it will be inside, and I won't have to worry about someone taking the tent. So that's a great thing. And I will take a moment and share my screen. Let's see. Okay, I want to make sure that everyone can see my screen. Okay. Perfect. And so we're going to take some time today to talk through Fannie Mae's Loan Quality Initiative. And one of the great things about LQI is that it helps us address the blind spot in the origination process, which is just by definition, it's the waiting period from the start of the origination process when that application is first pulled throughout processing into underwriting and the closing. Now, this is a time that consumers can incur that undisclosed debt or new trade lines that increases their debt to income ratio or their DTI. And as a result of that, they can jeopardize or delay closing or potentially cancel closing altogether. And so we'll take some time today to provide to give you an introduction to Fannie Mae's LQI or Loan Quality Initiative. We'll share its impact to lenders. Then we'll take some time towards the end of the presentation to talk through or explain what is an LQI full credit report, what is loan quality cross-check, say that 5 times fast, and undisclosed debt monitoring. But before we begin, one of the things that Shelley and I were discussing in our preparation for the event was a recent example of how one of our customers could have used that soft pull or one of our LQI products. And Shelley, can you share that story with us?
I sure will. I have several lenders and that I work with. And this one particular lender, I've been telling him about the LQI loan initiative. I've been telling him about LQCC and UDM. And he said, I don't understand why I need a soft pull before close. He just didn't pull anything before close. He closed the loan, had the borrower sign something they didn't have any more credit, and then went on. Well, he got a Fannie Mae buyback because that loan opened between the time of the application and the time of closing. So I got a phone call that said, can you get me immediately set up with those soft pulls? Would I have seen this? Would I have seen this inquiry? Would I have seen this loan? And believe it or not, Kendall, it was from his own bank. And yes, that same borrower went into his own bank and got an auto loan. So it was crazy that he didn't even know it, and it was his own bank. So that was really important to him. So these are the things that we will talk about, how to make that not happen and have a Fannie Mae buyback or a bad borrower experience during the process too.
Absolutely. And as we move throughout the presentation, there will be questions, and just know that we'll save those questions to the end. And please use the chat feature as they come to mind. Don't hesitate to, you don't want to wait until the end and forget your questions. So we'll take some time to review those after we wrap everything up. And so we'll begin with a little about factual data. One of the things that makes factual data different, and we'd like to say we're your trusted credit data and technology partner. We have a direct integration with the nationwide consumer reporting agencies, or NCRAs. We also have a direct integration with Fannie Mae and Freddie Mac. Now, some lenders ask, what does that mean to us, or why is it important that we have a direct integration with Fannie Mae and Freddie Mac? Well, with the transition to the digital mortgage experience, margin compression, the shift in the market from refinance heavy to purchase heavy, lenders are beginning to streamline their workflows. So what this means is that in order to get a DU result or DU findings, you do not have to enter any special characters. You'll click your heels together 3 times to get a Fannie Mae submission. It really streamlines that origination process. Now, factual data, we are part of CDC companies. Some of the companies that you may have heard of, Factual Data, of course, Data Verify, which is also known as Drive, Innovis, Data Verify Flood, and SBS. And so from the origination to closing, our family of companies has a touch point at each point of that loan in the process. And so by design, we're very familiar with the origination process, and our family of companies are here to help guide you through the origination process or that loan manufacturing process. And so, Shelley, did you have a story that you wanted to share before we get started, before we get to the good stuff?
Well, it's funny. I have a lot of stories I can share with customers that have had the same issue, with a loan showing up before. But yes, I have a customer that actually, and this just happened recently. He just called me and said, what can I do when this happens? And it's exactly what you were talking about, Kendall. They had a inquiry show up 3 days before closing is when they pulled their LQCC. And then now guess what? They don't meet the DTI, the debt to income.
Wow.
It's scary. So those are things that you will find in this. But what if they hadn't pulled that LQCC 3 days before closing and had gone to Fannie Mae? What would have happened? So they redid the loan, got them in a different program, and they got them there. But at the end of this, Kendall's going to explain it. We have 3 different products that can help with that. And maybe UDM would have helped him instead of the LQCC. But it's better to have something before closing instead of nothing and get that buyback.
Absolutely. And so that's actually, Shelley, you bring up a good point. That's where we're at in the industry. And Fannie Mae, that loan quality initiative, you'll hear me refer to it as LQI throughout the presentation. Mm-hmm. But by definition, what their stance on it is that they like to evaluate a borrower's ability to repay their mortgage. Of course, they think it's crucial for lenders to accurately assess the risk of each mortgage originated and to ensure that Fannie Mae selling guide requirements are met. Now, that's the verbatim version of that. They want to make sure that they have a quality portfolio of loans. And so Fannie Mae is really committed to a shared commitment with lenders to manage risk. It requires lenders to evaluate each borrower's ability to repay. Meaning that you want to make sure that the borrower is in a position to afford the mortgage that we're originating. Mm-hmm. And we'll cover 1 of 3 ways that most lenders use to identify that potential debt later on in the presentation. And Shelley, can you tell us a little bit more about undisclosed debt and what exactly is it?
Yeah. Well, an undisclosed debt basically is any loan or liability that exists at the time the borrower closes and it's not disclosed. So there's many times that a borrower doesn't think that maybe they just went out and bought a loan. Well, I can give you an example of one. This is kind of a crazy one, but I had a customer that one of their customers was building a retirement home. So they were buying another home, a residential home to live in, but they were building. Well, that inquiry or anything did not show up anywhere, but that was considered undisclosed debt because now they're going to have a mortgage. And that actually showed up on the UDM for us. But I mean, that's undisclosed debt. So if there's an auto loan they're trying to get, a revolving credit card, maybe they're opening new Kohl's for 10% off. And then installment loans. A lot of people will go out and buy for refrigerators and furniture, 60 days, same as cash, but it's an installment loan. So any of that is additional debt, and that's what they're looking for.
That is great to know. And I'm going to take a moment to turn to the group. Out of the 4 types of loans that you see are the revolving auto loans, revolving debt, installment loans, or mortgage loans. Which do you think is the number 1 type of loan that's identified by Fannie Mae? If you could take a moment and put your answer into the chat box, we'll review those after we wrap everything up.
Oh, I see some chats. I see them coming in.
We'll take a moment. Let's see. Auto. There's 2 for auto, and you're exactly right. In a study found by Fannie Mae did a study in their post-acquisition QC. 47% of Fannie Mae defects, and defects meaning that these are things that are debt that Fannie Mae has identified after the loan has been closed and sold to Fannie Mae. But they are for new auto loans. So kudos to Christine and Diana. And so 37% are for installment loans, and 14% of those defects were for mortgage loans. And to your point, Shelley, one of those things the one thing that we know for sure about your mortgage inquiries and the different types of inquiries are those permissible purpose codes. Now, what that does for those mortgage lenders that you have an inquiry, you're set up with the bureaus to be identified as a specific type of inquiry. In your example, that human error or that human element took a glance at it, or maybe just missed it on the and just didn't connect the dots to know. Well, in a data-driven environment, or automation-driven environment, UDM takes the guesswork out of that. It lets you know that there's a mortgage inquiry that's been on this date at this company. And it would have alerted that underwriter, processor, loan officer that something else is going on there. There's something that you want to take a closer look at.
Right.
Now, in the purchase-driven environment, we all know that purchases are really driven on a time frame. Most lenders use 30 days as a benchmark. You see some companies advertising 8-day close, 10-day closes, but when using or in a technologically advanced or tech forward or tech facing environment, I think the timing is everything. On average, undisclosed auto loans are open 39 days prior to closing, which speaks to the point that sometimes that inquiry that can be associated with that new debt or obligation is often found on that origination credit report. So again, that UDM or that undisclosed debt notification or any type of LQI or soft pull product really helps with that human error or element. Now, 70% of all undisclosed debt is open more than 14 days to close, 14 days before closing. Now, Fannie Mae's guideline is that that LQI or soft pull report has to be pulled 10 days prior to close. Now, given that metric that's found by Fannie, I ask, what does an extra 4 days of mean to your loan process? Meaning, how does that impact? If finding out that there's a new inquiry, how does that impact your process if you're able to address that 4 days sooner than that 10-day threshold? And Shelley, I know that you had a story or had a story on either the inquiries or how that relates. Could you share a little of that with us?
Yeah, and this statistic was an inquiry is usually on the credit report, and that is sometimes missed. And that's exactly what happened with another one of my clients that was building. It was the same one that was building, but what happened is the inquiry had an unusual name, something like a green or something like more magnolia, something just unusual. And the loan officer didn't relate to it being a builder, didn't relate to it being anything. They just thought it was maybe a credit card, something like that. And they weren't looking at the permissible purpose codes out to the right of it. And it went all the way through underwriting and everything. All they would have had to do is Google that name, and they would have found that was a builder in Florida. That's all they would have had to do. So that was a Fannie Mae buyback because they did not catch the inquiry that was actually on their credit report. So sometimes looking at those inquiries to just see and to ask, and at Factual Day, we can call that builder, call those people and find out, is there a loan being purchased or started with them? But it was kind of an interesting thing that happened.
I think it's important. I think given the shift to purchase-driven digital strategies, that borrower experience, workflow efficiencies, and margin compression, those are three things that are at the top of mind. And having a soft pull product in place that helps identify those new inquiries, it helps from a margin compression and that workflow efficiency standpoint. So having that in place, I can see the benefit of how it would have helped identify that inquiry at an earlier point in time. So we'll take a moment to talk through LQI, or the Loan Quality Initiative, or our LQI Soft Pull Credit Report. Now, the great thing about this is that it can be, of course, 1, 2, or 3 bureaus. It is a full credit report. And that's my experience with this, is that it has that stare and compare is the most, there's a term that I hear most often, because it means that Someone has to physically pick up that credit report and compare it with the origination credit report. At a time in which the digital mortgage experience or that digital mortgage is at the forefront of lenders' conversation, and workflow efficiency is at the top of those conversations. It may not be the best option if workflow efficiency is what you're looking for. You can't access that through our secure website, FD Web, through Drive, or through your LOS, or loan origination system. Now, LQCC is what I like to call soft pull on steroids, so to speak. So like LQI, you can have that 1, 2, or 3 bureaus. We make the ordering process, of course, very easy. The main difference between the two is that LQCC is going to highlight those differences. So what does that mean to that underwriters that's ordering that LQCC report? So rather than parsing through or trying to figure out comparing trade lines from the origination credit report to the LQI or soft pull report, well, LQCC brings those changes to the forefront. And so all of those things that are important to lenders, like new inquiries, change trade lines, public records, even scores, those can be brought to the forefront. So at a glance, you know if there's been any changes in that borrower's credit or credit history. And finally, UDM, of course, is one of my favorite products to talk through, because I've seen the impact of it. And so with undisclosed data, that UDM, of course, it's managed through the Drive platform. We do have the ability to batch those UDM options, and similar to LQI, LQCC, UDM can be 1, 2, or 3 bureaus. And so the neat thing about UDM is that you get a daily feed of soft pull activity, meaning that at a moment, if a borrower has an inquiry 3 weeks before close or 2 days before closing, you're going to know that real time. And what does that mean to lenders? You see a reduction in the repurchase risk due to an undisclosed liability. It reduces the amount of fire drills 10 days prior to close. And by fire drills, meaning that, of course, Fannie's directive is that we pull that LQI or LQCC report 10 days prior to close. Well, if there's a finding or a new inquiry or something is identified, well, now you have 10 days before that closing date to document that inquiry appropriately, or the new account appropriately, and try to make sure that you still hit your closing date. What UDM does, it gives you a daily peek at any potential changes in credit. So if that borrower has any new inquiries, new trade lines, you know that almost real time, rather than waiting to 10 days prior to close.
And I know this is one of your favorite products, like you said, Kendall, because you've seen it really help your customers. And I was telling Kendall when we were practicing for this as well, that it's probably been one of the hottest topics I've had this year. I'll have customers that use either the LQI or LQCC and want more of a digital experience. And the UDM is much more of a digital, it's automated. It can be used through Drive with automatic stops and automatic starts. So there's a lot of cool things to it. But right now, I think the UDM is one of the hottest topics in the industry.
Yep, and surprisingly, Shelly, what I found, what my customers that are actively using UDM, what they pointed to is not so much as the workflow efficiency. That's great. The fact that you know real time when something happens, that's great. Well, it pointed to the borrower experience and the benefit that they've had with their referral partners. And I think that we're in an industry that referrals are key, and they are the lifeline of our business. And with us, whether you're a loan officer or you have those lenders have a relationship with a builders, realtors, the last thing that you want is that negative customer experience. But UDM is a more proactive approach to that soft pull and identifying new debt. And it helps build relationships because now it turns from a 5 drill that's 10 days prior to close to let's work together to document this so we still are able to meet our closing date and deliver what we promised.
Makes sense. And Kendall, you and I were talking today as well about those trigger leads. And if a customer would, let's say, for instance, I'm a loan officer, I've got my loan in process. Well, now another mortgage company has bought that trigger lead from the bureaus. They're calling my customer. And what if they pull credit? Well, if they're using undisclosed debt monitoring, they'll see that XYZ mortgage company has pulled credit. They'll get notification. And that loan officer can reach out to the customer to say, what's going on? Are you looking at shopping me? Are you checking, what's going on? So that's another benefit of this is to help maintain your client.
What's interesting, it's funny that you say that, Shelley, because I just had it like today, this morning, a loan officer, they reached out, the borrower had fell off their radar, but it turns out the reason that they fell off their radar was because they had gone to another mortgage company. And that borrower took the time, and again, which speaks to building relationships, took the time to send that initial loan officer a note thanking him for his business, but they'd already closed with another mortgage company. And so these are the things that UDM helps with. Again, a UDM is a more proactive approach to that LQI or FNMA's LQI initiative. Yeah.
Well, we definitely know that it's better to have something, forward like that instead of waiting till the after close and then Fannie Mae says, oops, you got to buy back this loan. You didn't tell me what you're doing. Well,
Absolutely.
Do we have any questions from the audience on undisclosed debt or LQI or anything like that? Melissa, I know you're on here now, so you can look at the chat box for us.
Or maybe not. And so let's take a look at that chat box and see what we have here.
I don't see any questions, but maybe you check the chat box too.
No, I don't see any either. I think we're either getting really good at this or we kind of lost it.
Yeah, I don't see any Q&A or any chats coming in at this time. So I think you may have addressed anyone's questions already.
Well, that's awesome.
Well, that is great. Well, I'd like to thank everyone for your time. And in closing, I do want to point out, I would like to say that as mortgage banks and mortgage lenders rapidly adopt that digital mortgage process to achieve better efficiency, cost savings, improve that customer experience, please keep in mind about that quiet period that LQI helps address, whether it's that LQI soft pull credit report, that LQCC, or that loan quality cross-check report, or that UDM active debt monitoring. One of those 3 tools can help lenders avoid getting blindsided at closing by undisclosed debt or potentially losing a borrower. So thank everyone for your time this afternoon, and please feel free to reach out with any questions.
Thank you, Kendall. Thank you, Shelley. Thank you everyone for joining. I will please be on the lookout for today's session recording on your email. And thank you, everyone. Have a nice day.
Thank you.
Thanks, Andre. Thank you. Have a great day.
Bye-bye. You too.